One of the most interesting developments over the years has been the growth and evolution of private debt. Though many still equate it with direct lending, that is, loans made to private companies predominantly in the middle market, the fact is private debt is a rich and varied asset class spanning corporates, real estate, and infrastructure, and also spans the risk-return spectrum from core direct lending to distressed, opportunistic lending, and specialty finance. And increasingly, private debt is being seen for what it is, a solution for myriad investor objectives. Now, prior to the pandemic, private debt was largely regarded as a bond replacement strategy, capable of generating superior yields during the era of low and zero interest rate policies. Fast forward a few years, and yields on the 10-year Treasury are hovering near 5%. But at the same time, the role that private debt can play in an LP's portfolio has also changed. In addition to being seen as a substitute for fixed income, we're beginning to think of private debt as a diversifier, capable of generating equity-like returns over the long run. Now, all this is to say that building an allocation to private debt is no longer as simple as swapping bonds for loans. It requires careful planning and analysis and data-backed assumptions to build one's assets strategically, as well as to fine-tune one's portfolio in the near term using tactical adjustments. Joining me today to discuss some of the finer points of building a private debt portfolio is Christian Frei, Stepstone's head of risk and a partner in our Zurich office. Christian, welcome back to RPM.
Hi, Michael. Thanks for giving me another opportunity to talk about our work here at RPM.
Yeah, I think this makes 3 episodes now. You're our favorite guest, it seems.
Might be. I haven't counted them.
All right, so Chris, let's tuck in. We're talking about something that you focus on, strategic asset allocation, or SAA. But before we dig any deeper, I want to discuss our recent partnership with GIC. We partnered with them on a paper about private debt portfolio construction. I've received a lot of questions about the genesis of that project, as I'm sure you have as well. Tell us, how did that project come about?
So GIC does have an experienced team that's responsible for asset allocation. And so they were working internally on a framework to help them decide how and how much they should allocate to private debt. They have approached us for contributing in a couple of ways. On the one side, on the taxonomy, so how to think about the different components in private debt, the sub-strategies. Another input that you're looking for is the parameters that go into computing an asset allocation, mostly risk and return, but also the supporting data that we have to support these assumptions. Then last but not least, they were also looking to us to tell them about how current market conditions look and where there might be shorter term opportunities for portfolios. And then they had, before they went about that project, they were looking at what's available in the literature out there, and they didn't really find a lot. And so they felt like it might be interesting also for other LPs to learn and that we could share the experience we have with them. For us, on our side, we've been working with a couple of LPs on similar projects, but that idea of actually putting it down in a paper was really the catalyst to sit down, spend the time, and put it into a digestible format in that paper.
Now, we've been talking about asset allocation, SAA, for a long time now. I know you and I have worked on a paper in the past. How does this recent paper different from our earlier work?
So the short answer is, the earlier paper or papers dealt with asset allocation across equity and debt and across all asset classes, while what we're looking at here is just private debt. And by focusing, just on private debt, we were able to take, or we are taking, a much more granular view in terms of strategy breakdown. So for example, we modeled the different segments or market segments of direct lending separately, but also we look at the different specialty finance strategies separately. We also use risk metrics and return metrics that are a bit more applicable to specifically private debt. But despite these, differences, we're still discussing, the same core competencies that we consider key for successfully implementing a private markets program. So specifically, we express our conviction that, deriving an asset allocation is only, one of the many process steps, that one needs to master to implement a private markets program. And other steps that we touch are, doing realistic pacing analyses, ensuring efficient capital deployment, having access to good GPs, and then as well, monitoring and risk management.
So Christian, that's really fascinating. And I'd be curious if at some point in the future, we take a similar tact and do SAA papers on all of the private markets asset classes. So going back as far as 7 to 10 years, when discussing the rationale for private debt and its place in a portfolio, we often discuss that as a replacement strategy. Now that market conditions are significantly different, is that still the case?
Well, I think in some way one can still think of the allocation in terms of a replacement, in the sense that if you add an asset class to an allocation, it replaces or crowds out other allocations. But what's certainly the case is that for most investors, with probably a few exceptions, only a few years back, private debt was just one of many alternative assets in a portfolio. And as alternative lenders stepped into the void left by banks and the asset class grew and investors got more familiar with private debt and its risk and return characteristics, they started to more and more view it as a strategic component of the portfolio. But also, many investors probably associated, as you said, private debt mainly with corporate direct lending, but private debt really includes all collateral types, from infrastructure to real estate, all the way to specialty finance. And so as allocations in portfolios grow, and as considering the broad spectrum of collateral types that it spans, the need for a systematic approach to allocation decisions clearly increased. And I think that really reached most of the LPs by now.
So Christian, we're really getting to the heart of the matter here, and that's the portfolio construction. A lot has been written about the demise of the traditional 60-40 portfolio. And in our paper, we offer a case study for how investors might think about supplanting a portion of their traditional portfolio with private debt assets. Can you walk us through that?
Yes, sure. We should not forget that ultimately private debt is a fixed income asset with credit risk. And so, for many investors, it will be about substituting parts of the fixed income allocation with a private debt allocation. The discussion about relative attractiveness of debt versus equity is also an interesting one, and it's probably particularly interesting in current times, but that would go beyond the scope of our podcast today. But going back to your question about supplanting a portion of the traditional portfolio, so to do so, it's obviously not sufficient just to look at absolute return. As you point out, with treasuries around 5%, duration has become attractive for many investors that had not considered it attractive up to now. And considering that some private debt assets are floating and others do possess duration, one needs to separate the duration component of the return from the spread component of returns. And similarly, risks different across strategies, as you already highlighted. And clearly, the tendency is that higher spreads will come with higher risk. And to demonstrate what the benefits of a private debt allocation in a traditional portfolio could be, we prefer to look at two generic cases. And the first generic case is when we demonstrate what the return pickup can be, or what return pickup can be achieved if one substitutes part of the fixed income portfolio with a private debt allocation that has the same risk. And in a second case, we then evaluate the reduction of portfolio risk if one substitutes with a private debt portfolio of equal return expectations. And so by this, one has two extreme cases that can give some insight as to how also combinations of the two objectives might do.
That's really interesting. And again, I'd encourage our listeners to download the paper so that they can see the exact percentages that we estimated in our models. So Chris, when I was flipping through the paper at first, and specifically with respect to the risk return diagrams, they look like standard risk return diagrams as we know them. But taking a closer look, I realized that we're not using volatility as the risk measure. Is that accurate?
Yeah, that's a very good observation. To work with volatilities in a portfolio construction, one needs time series of time-weighted returns from where volatilities can be computed. And such time series are not available for most of the private debt strategies that we cover. So that's one of the reasons. The other reason is that we need a risk measure that makes it possible to study the integration of private debt allocations into a liquid credit portfolio. That is a risk measure that is applicable for traded and non-traded assets. And if one takes volatility, one faces the challenge that the price discovery process for traded credit and private credit is different. In the case of private debt, valuations are adjusted in anticipation of increased realized losses. So traded credit prices, of course, do the same. However, they tend to react much more strongly to anticipated losses, and they do so, much earlier. And so to avoid being caught in the discussion about, which of these two volatility measures is better, or how to bring them, on equal footing, we decided to settle with a concept that we call stress losses as a risk measure. And stress losses we define as, peak losses exceeding, long-term expected losses or long-term average losses over the period of 12 months. And this is a risk measure that can be estimated for credit independently of whether it's traded or not.
So this is really interesting to me, and I think it ties back to an earlier point we made about evolution. So as the asset class has matured and evolved, so too has our thinking about it evolved to the point where now we're developing or using risk measures that we may not have considered at a previous point in time. I mean, it's just part of the natural cycle, the natural occurrence of things. I'm curious about how, our use of different risk measures than the traditional measure of volatility affects the data that we collect. Can you take us behind the scenes to discuss the data that undergird these models?
Yeah, sure. Despite the increased appetite by investors for private debt, there's still very little data publicly available, and specifically asset level data. So for most of the modeling, we rely on data collected by us from our GP relationships. And we collect this data and analyze the data as we conduct due diligence on GPs and update track records. And over time, so by this, over time, the data set has grown to about 20,000 credits with over 100 data points per transaction. And so that's the repository we mainly use for all these different modeling exercises we are doing.
Oh, so 2 million plus specific points about credit transactions. So Christian, let's shift from the strategic to the tactical. Our private debt team has been producing a lot of quality research lately, much of which is related to short-term changes in credit markets. Now, as we well know by now, constructing a portfolio is a long-term endeavor with commitments to funds that cannot be adjusted to capitalize on short-run opportunities. Can you talk to us a little bit about how credit investors can position themselves to pounce on near-term opportunities, and then how to plan for these opportunities when they're constructing a long-term SAA?
Yeah, so the question about implementing tactical or short-term opportunities is one that many of us, get regularly. And our answer typically stresses that it is still important of having a strategic plan from where to improvise on, because otherwise it might, one might easily get lost. And at the end, making tactical decisions is all about, relative value decisions. And so it's about observing changes in relative value, which then informs the investor, on deviations or how to deviate from that long-term plan and shift commitments on the shorter notice from one allocation to another. And I'm stressing the relative value because one might, for example, see spreads widen in one area of the private debt universe and conclude that, well, yes, there is an opportunity. However, if one looked at, the full spectrum of the private debt universe, one might realize that, spreads widened, everywhere, and that the relative increase in spreads might be somewhere else. And so it's important to have a, holistic coverage of spreads and spread changes over time. Another aspect that we think is important for capturing shorter-term opportunities in credit is that one has to have established relationships with GPs that can source these opportunities, but also to have the necessary structures in place that can hold securities or investments associated with these opportunities. Because otherwise, if this is not in place, the opportunity might be gone before the first investment can even be funded.
Christian, thank you again so much for joining me today. Be well, and looking forward to seeing you soon.
Well, thanks again for giving me the opportunity to talk about our research here.
Thank you for listening. For more color on today's conversation, head to stepstonegroup.com, where you can find a copy of the paper Christian and I discussed, along with the rest of our thought leadership library. RPM is available on Apple, Spotify, Stitcher, and other podcast platforms.